In an effort to control the spread of the deadly coronavirus, which has claimed more than 6,000 lives, Germany's largest lender, Deutsche Bank, will operate globally in split teams from today. The bank, which has been trying to engineer a turnaround after years of losses, has already split some operations in various centers in recent weeks. Some executives and investors have feared that the outbreak could stall the bank's restructuring efforts, and Deutsche Bank's shares fell last week to a record low amid a broad market rout. The rapid search for the coronavirus cure has clearly altered global economic outlooks for 2020. Recently, the World Health Organization classified COVID-19 as a pandemic, suggesting a possibility of further shutdowns across economies with knock-on effects likely to negatively distort global trade and mobility. Our research agency, Cardinal, just released a detailed report on Nigeria's economic outlook, and we have their head of research, Philip Anegbe, who is with me in the studio to give further analysis on this. Philip, you're welcome, sir. Great to have you on the Global Business Report. So I believe the title of this report is Nigeria Economic Update Backed to the Wall. That sounds dramatic. I guess it's appropriate for our times with where we are now. Give us what's going on. How are we back to the wall right now?
Nigeria remains an oil-producing country. Significantly, it contributes to dollar earnings, and also it contributes to our reserves. So a shock to oil prices is likely going to negatively impact the Nigerian economy. We've seen the federal government call for several committee meetings to actually review the budget. So we may see some sort of a budget review meeting by mid-year at the latest. So these actually tell you that the economy is still very susceptible to oil price shocks. But in addition to that, you have the whole global economy actually reeling from the impact of coronavirus outbreak. Like you said, it's been recently classified as a pandemic. It has actually distorted the global demand outlook, and we've seen commodity prices tumble, right? But more recently, we've got more intense pressures coming from the coronavirus outbreak. The country is actually shutting down. So what that does basically is actually to disrupt a lot of global trade, and the knock-on effect is likely to actually affect Nigeria adversely. For Europe, for instance, you've seen several countries shut down, Italy, and now you hear stories of Germany as well. So if that happens, you have it that about 51% of our exports may be affected, because Europe currently contributes about 51% of our exports. So Nigeria is very, very exposed to these developments in our view.
All right, so I'm showing here you've got, as you mentioned, the global growth imbalance, crude prices going down, natural gas prices going down, even copper, wheat futures, and so on, those going down. There are some variables that you looked at in your reports. Oil revenue, non-oil revenue, CapEx, the fiscal deficit, debt service burden growth. Can we go over some of those on your report with regards to what you're seeing, how those variables could affect us?
Now, for oil revenue, it's clear now that at current prices, crude oil price is about $20 lower than our budget benchmark price. So that tells you that there may be significant shortfall in terms of oil revenue, and that may actually lead to expanding fiscal deficits. So the worry is, if this happens, the government may actually look to to other means to actually fund its budget. It implies greater borrowings at maybe relatively expensive cost if they are looking to borrow from outside. And of course, there's also implied pressure on what happens on the CAPEX front. We know the economy has been pushing for significant ramp-up in CAPEX to actually boost growth. But that may actually go to the back seats, basically, because when we saw something like this in 2015, what the government basically did was to actually reduce CAPEX expenditure spend. So we are forecasting CAPEX intensity to come down to about 17% from the over 35% that is implied by the budget document. So that's some reduction.
That's not nice at all. Okay.
Not nice at all. And what that would do is more or less drive pressures in CAPEX-sensitive sectors. So those kind of pressures are likely going to suppress growth, which speaks to why we also adjusted our growth expectations for the current year as well.
And that's one of those CAPEX targets is infrastructure. The badly needed infrastructure that we need CAPEX spending to go towards. What a fiscal deficit.
Yeah.
I'm saying that's also expected to widen at this point if oil revenues can't come in.
Yes, even if we manage to maintain crude production at 2.18 million barrels per day, which is the budget target, we are still estimating a shortfall, a deficit basically of about 700 billion. So to correct that or to correct for that, you have to adjust areas where you can adjust. We all know the difficulty in adjusting a recurrent or debt service spend or plans, basically.
Right.
Because you have to meet recurrent expenditure, you have to meet debt service. So the fall guy will always be the capital expenditure leg. What they'll have to do, basically, is postpone some capital expenditure, and that may have some negative impacts on the economy.
Right.
It is also important to note that what we are currently facing is some sort of a second-order effect on the Nigerian economy. We are seeing effects from falling commodity prices. We are seeing effects from trade disruptions globally.
Yes.
But then there's also the risk that a first-order effect may be unlocked if the virus actually spreads within the domestic economy. That will lead to significant business shutdowns and disruption of local activities. So that may even be graver in our view.
Oh, wow. That's not pretty. And of course, just to emphasize your point, if you are servicing your debts, that has to be priority number one. So keep your creditors happy, and so of course, the capex side expenditure, that's going to go down. Not pretty. Okay. You're saying that weaker fundamentals may force currency repricing. This is the touchy subject that we've had now. We've been going back and forth about this. Give me your thoughts, please. You're saying weaker fundamentals may force currency repricing in 2020.
As it stands, we are facing a twin deficit. We have the fiscal deficit, which would only get wider as oil prices continue to fall. And of course, even when you have the executive likely to actually amend what they do on the capex side, the deficit is still likely going to be larger. So fiscal deficit, and then you have a current account deficit. For some time now, the current account deficit have been driven by services-induced pressures. So both more or less speaks to some sort of a currency repricing, looking at it from the fundamental standpoint.
Okay.
And then you've seen pressures in inflation, right? Foreign investors will always pressure you to actually compensate for these changes. And you can compensate for these changes either by devaluing your currency or maybe raising rates to attract FPIs.
And
but like we always argue, and we continue to raise rates.
Exactly. Raising them since.
Yeah, and the sort of funds we need, right? We need more long-term funds, right? For more long-term funds, you have to go the route of significant reform changes. And that will speak to reforms even in the currency segment or the currency management front, right? So the more rational thing to do, or the more sustainable thing to do is to actually reprice the currency in line with fundamental changes. But we know how touchy that issue is.
Very touchy.
And that may more or less play a hand in it.
Incredibly touchy. But as you said, there's looks like there's only one way to go. Let's talk about the equities market now. You've got here equities. Brace up for another negative close, but strategic positioning could, rescue the proactive. Talk about the equities market and what we're seeing there.
Yeah, we think that in the equity space, we may likely going to see flight to safety. A lot of sell-offs are likely going to continue, especially in the near term. We've seen that the fundamental story has significantly shifted. Oil prices at about $31 per barrel is significantly lower than what a number of companies actually projected. So that's likely going to affect demand, overall demand for companies' output. And of course, companies that are also reliant on export are likely going to be badly hit. The last time we had pressures of this kind, I think between 2015 and 2016, the sectors that were most affected are cement sector because it's highly cyclical.
Yes.
We had the brewers because they demand a lot on importation, especially barley, importation of barley. And then other manufacturers that are also open to importation of raw materials from abroad, they are likely going to be negatively impacted. So those companies listed in these areas are likely going to drag the index lower in our view. But then you may have pockets of gains across some names, especially in the banking space for banks that are more or less net long dollar position. If a devaluation happens, and the risk is increasing.
Yes.
So if a devaluation happens, you may have some sort of
big windfall.
Big windfall for the likes of GT and Zenith.
Okay.
Right? But then you also have to worry about what happens on the MPL front. There's this push for credit creation. It may come at the expense of significant impairment, given that macro fundamentals are getting weaker. They are
declining. Excellent point. And that's, of course, we're speaking about the LDR, the loan deposit ratio, yes?
Exactly.
The push for more credit. Is this a good time to be pushing the banks against the wall, as your report states? All right. Okay, real quick, still on equities. What about bargain hunting? Is there an opportunity for bargain hunting?
Significant opportunity for bargain hunting opportunities. But what we advise our clients to do is actually to stagger your trades so that you avoid catching a falling knife. You stagger your trade because market is still likely going to fall some more. So you stagger your purchases essentially so that you don't miss out when the rally starts. Because the expectation is that this is going to last for this is going to last for a couple of quarters, right? So stocks are really cheap because a number of them have been oversold.
Right.
Right, they've been oversold. And with the continuing pressure, you want to take advantage of stocks with sound fundamentals, with clear stories. We like some banking names. I've mentioned Zenith and GT. They are at ridiculously cheap levels at the moment. You want to take advantage of that as you move forward, basically.
All right. But of course, for our viewers, do consult a financial advisor before acting on any stock market material that we've discussed. Real quick here, I also wanted to, and this is a fantastic report, very, very in-depth. We talked about Deutsche Bank at the top of the hour. They released their own coronavirus report, and they had 20 questions for corporations that they asked, a number of questions as to whether or not they could be ready to deal with the outcome of the coronavirus. It was a long list, a part of their recession risk and markets from Deutsche Bank. I wanted to get your thoughts on some of the questions that they had there, talking about, have you completed a scenario analysis for stress liquidity scenarios and availability of undrawn bank lines, and a number of other questions in that regard. Now, I know, of course, that I think we're talking about this was probably a different environment, but here, are there any particular, those corporate questions that corporates can take here with regards to reacting to that? Is that?
Yeah, in terms of reaction, I think you are seeing a lot more of those kind of reactions in those markets because they are facing a first-order effect. Outbreak in places like Italy and Germany are significantly way higher. So yeah, they had that sort of a direct hit. But yeah, what we are seeing is some sort of a second-order effect, and that is why we are more reeling because of depressed oil prices and, of course, slowing demand. So what companies are likely going to do is actually scale back on their capacity expansion plans, at least for the time being, because we have a number of companies actually running on excess capacity.
Right.
So they may not look to actually do high or significant capex expenditure spend in the near term, or more or less they may choose to actually wait and see how events unfold before actually materially investing, especially in the current year. But in terms of taking position to actually benefit from the volatilities, I've mentioned a number of companies, especially banks, that are looking well positioned to actually take advantage of developments. But when macros are getting weak like this, you do well to actually stay away from the cyclicals.
Good stuff. All right, well, still with Philip Anegbe of Cardinal Stone. We're going to take a quick break. Global Business Report. We'll be right back. Welcome back to the Global Business Report. Now, at the CBN Roundtable, Growth 2.0, General Manager of Nigeria's Petroleum Corporation, Mele Kyari, painted a grim picture of tougher times ahead in the country due to falling oil prices caused by the coronavirus epidemic. According to him, we have about 12 stranded Nigeria liquefied natural gas cargoes because of the collapse in oil demand associated potentially and significantly with the coronavirus. Now, this has never happened before to Nigeria's LNG cargoes. With respect to liquid cargoes, Kyari disclosed that they had been badly hit as well, with Nigeria accounting for 50 cargoes that had not found landing.
The capacity to finance the oil and gas sector in this country. And if you don't do this, and with the competing needs, with the competing resources across the world, what it means is that you cannot compete, you cannot produce the Nigerian oil because nobody will put his money here because this is a net heavy cost oil producing territory. So we are doing something to pull that down.
All right, Philip Anegbe, head of research at Cardinal Stone, is still with us to react to this. So, Philip, it's on the back page of this day, behind the figures, our long-running finance column by Ijoma Uwogu, who went in depth as to Kyari's comments at the round table, where he, was pretty honest about our situation, as we've just mentioned there. And, the main issue that this piece delved into was the increase in cost of production of oil, right? A barrel of oil for Nigeria from like the mid-late 90s up until now, where we are now. So I want us to discuss this because it's pretty alarming with where things are now. But what's your take?
So what we are seeing, or what he's trying to address basically, in my view, is the switch, right, from doing more of onshore production to the relatively more expensive deep offshore. Basically, I think the ratio was about 95 to 5%. Now we are seeing close to 50% in deep offshore, which is relatively a relatively more expensive area to operate. And I think that's why the average cost of production in Nigeria has gone up to closer to $30 per barrel,
right,
versus about $17 for onshore operations. So what that brings to your mind is Nigeria's low capacity to actually compete on the oil price front globally. And that's why you're seeing a number of our cargoes still awaiting off-takers. So that may have a significant impact on what happens to production domestically, because you cannot continue to ramp up when there are more or less scarcely off-takers to take your products. But added to that, you would want to also consider the discontent of a number of domestic upstream producers after the production sharing contract was passed or renegotiated. Then you also had the finance bill that actually increased more or less dividend taxation for oil players, and that also more or less irked a number of oil producers domestically. So what you may find is that return on investment for a number of upstream players may actually be lower. And that more or less may speak to a reduction in capital expenditure spent for a number of them. And that is not good for the economy.
Okay, so I mean, at this point now, it seems that this is just like a major exogenous shock where we are almost helpless to what's happening. You know, how, with your outlook, is it that we're hoping that the Saudis and the Russians can quickly come to some type of agreement? Do we hope for that? And then, well, how much longer do we see this playing out?
Well, the word on the street is that Russia may be looking to come back to the table between May and June this year.
Between
That's
what?
word on the street. But you want to so between May and June. So if that happens, I know that's very low probability that's going to happen. But then coming back to the table is not to say, of course, they're going to reach an agreement. Or anything. But you also have the potential or the for falling oil prices to actually affect shale oil production.
Okay.
If you look at the average cost for shale producers, it's above $40 per barrel. So that may actually change the dynamics if it forces some sort of a structural change in the supply world. But you don't expect any of that to happen anytime soon. And your reaction speaks to it.
Yes, that is.
So you may see this current crisis actually move into even the third quarter, even the fourth. It may get worse. And if that happens, we may begin to actually fear the worst. And
the worst is the big R word. Recession, right? Because if it stretches out, we're looking at let's see now. Okay, Q1. This all started happening towards the tail end of Q1, right? So for Q1 2020, I don't think we're going to see that much. I mean, I want to get your thoughts. I'm thinking it's probably Q2, Q3. But how do you see it?
Yeah, absolutely. You look at average oil prices for Q1, it's still above $50 per barrel. You check it as at this morning's number, it's still above $50 per barrel. So we are less likely to see an impact on overall economy based on that. But for Q2 and Q3, you may see a bigger impact. You take a cue from what happened after the collapse of oil prices in the last quarter of 2014. It took like some 4 or 5 quarters before it now cascaded to a recession. So, but in this case, you may see it may be a bit faster because of the whole coronavirus impact on global demand and even local domestic reactions. So it may be a bit faster. So we are saying maybe Q3, Q4, you may see some sort of contraction in domestic outputs if the current problems actually linger.
Let me ask you this. Can you, because so the last time we went into recession in 2016, yes, it was one catalyst that caused it, which was oil prices fell. I just want to get your thoughts. Can you count the coronavirus as one separate shock and oil prices as can you count them as separate or as one? Because the conversation has been that we can't withstand 2 separate shocks. Even the global economy cannot with coronavirus and where oil prices are. But how do you see? Can you separate them, or do you see them as because essentially the coronavirus led to less demand for oil, which is what pushed OPEC to come together and all this. But how are you seeing everything from a macro view? Are you putting them together or separating them?
Yeah, it depends on the approach you want to take, but I would prefer to separate them. And the reason is this. The coronavirus actually affected demand outlook. OPEC, as a result of that, was forced to react. right? OPEC trying to bring Russia to the table to negotiate production cuts. But then another issue arose, and that was the issue of shale producers benefiting where others are cutting.
Right.
So that more or less now speaks to market share concerns. And you have the likes of Russia and Saudi more or less announcing recently that they are looking to even ramp up on production in order to gain more market share. So that market share battle is another dimension that is more supply side as opposed to the demand side factor for the coronavirus. So I'll say there are two, and those two impacts are really likely going to affect oil-producing countries, particularly those that have actually failed to diversify significantly over the course of years.
Philip Anegbe, Head of Research at Cardinal. Thank you for this in-depth discussion here. I appreciate your insights on what's been going on around the world. We have to have you back.